Hello, everyone. Welcome to today's edition of Blue Talks. Today, we'll be continuing our series. Well, it's the final version of or edition of the series, Impact of COVID-19 on Key Focus Sectors in Nigeria. Earlier in the week, we spoke around sectors around oil and gas. We spoke on power and infrastructure, spoken on telecoms, media, and technology, as well as other sectors as well. Today, we'll be looking at the conglomerate and the financial institutions sectors. Today, we still have Olu with us, Olu Delano, who is the head of client coverage at Stanbic IBTC Bank. With him are another set of fantastic ladies who will be continuing the conversations with him. Hi, Olu. Thanks for joining us today.
Hey, Taiwo. How you doing?
Very well, thank you. We see you have another set of ladies who will be bombarding us with a lot of insights today.
Yes, thank you. And thanks everyone for joining. Again, the team that is in front of you today is the client coverage team. And we are the relationship team that engages our corporates. Within the bank, we have three main business units. One is personal and business banking that deals with individual accounts and small to medium size and commercial clients. And we have the wealth group that deals with our pensions, asset management, and then corporate and investment banking, which the corporates in those worlds is around 10 billion naira, $20 million size and above. And within those, the group of clients, we've sectorized them into 6 core sectors. We have the oil and gas, power and infrastructure. We have the consumer sector and telecom, media, and technology. And we have financial institutions and conglomerates and industrials. And that's where we have the ladies here. And if we look at how we are structured as a group, we've put those customers in play. And then just around 27th of July, 27th of February, the COVID came into Nigeria. We tested the first, we had the first positive test of COVID-19. And since then, the positive test in the region of close to 3,000 people. So the government and the president put a lockdown on the key cities in Nigeria just to make sure that we don't have the spread of the virus. So the conversation today is with 2 sector heads that how have we been engaging our clients and how have the customers been managing those situations. We're going to pivot now to Yewande, who runs our financial institutions group. Hi, Yewande.
Hey, Olu.
So good afternoon. So you've been engaging yourself and your team. You guys have been engaging with banks and non-bank financial institutions in this COVID season. What have they been sharing with us over the last couple of weeks?
All right. Thanks, Olu. I guess the key thing that everyone has been talking about is on how to ensure continuous customer service delivery, even in a lockdown situation. So what we found is most organizations within the financial institution world have split up their teams into 3 main teams. You have people classified as essential workers. Those people actually come into the office and work from the office and have been accommodated around the various locations in the office. And then you have the group that has been tagged as the work from home team. So this set of people actually work from home, have been enabled to actually do their work, be it insurance, asset managers from home. And then you have the people, another set of people working from the disaster recovery side. So I guess the major thing here is having the financial institutions classified as essential. Organizations had to take a swift decision in categorizing their workforce into those 3 broad teams and basically to continue to give service to their clients. So that's basically what we've been saying, and work has actually continued across the world that we cover.
Thank you. Okay, so from Stanbic IBTC's perspective, what does financial institution coverage, what does that mean to us?
All right, thanks, Olu. So financial institutions coverage is actually a team that covers banks, and in banks, I'll say local and international banks that cover financial institutions and non-bank financial institutions. So on the banks, we have both local and international, but I'll quickly focus on the local banks. The local banks will put a category of into three places: commercial banks, non-interest licensed banks, and merchant banks. So commercial banks are basically the banks that act as an intermediary between the surplus spending unit and the deficit spending unit. So basically providing banking services between the two units in the economy and ensuring that people have access to banking services. While the non-interest licensed banks are banks that are built on principles that uphold a positive ethical message. It includes various things such as avoidance of interest rate payments, contractual and legal uncertainty is actually off the table, leniency to debtors, investments in certain forbidden commodities. At the moment in Nigeria, we actually have just two banks that are licensed as non-interest interest licensed banks in Nigeria, and they are guided by some principles that I've mentioned. I mean, one thing I would like to highlight here is they are always very keen on ensuring that wealth is distributed and generated across the spectrum and that the business is actually legitimate. So there are certain types of businesses that non-interest banks will not typically go into. And then the third bucket that I would like to also talk about amongst the banks are the merchant banks. So merchant banks historically had dealt in facilitating trade and trade production of commodities, but merchant bank has metamorphosed in recent times, and they are actually focused on providing capital in the form of share ownership or loans to the clients that they're interested in collaborating with. And what you find is because they have put in some form of equity, they tend to provide financial advisory services to this bucket of clients that they're focused on. Another group of banks that I would like to also talk about is the microfinance banks. So microfinance banks are basically banks that focus on the bottom tier of the market. So what do I mean by that? I mean people that have low income that are irregular, or income that are unpredictable. And I guess the key word here is this set of people are economically active. So they're trying to generate some form of some form of livelihood for themselves. So people that, the market, people that sell in the market, people that blend pepper, basically, they tend to focus on those set of people. Today in Nigeria, we currently have almost 900 microfinance institutions, but the CBN is looking into optimizing that sector to ensure that we have a more resilient microfinance bank. The next one is development finance institution. As the name connotes, it's pretty much focused on development. So you find some of them focused on critical sectors of the economy, such as agriculture, manufacture, or infrastructure, or even small, medium enterprises. So what you find in this regard is the fact that they are focused on critically developing certain sectors. In Nigeria today, we have 6 of them, and the 6 development finance institutions are all regulated by the CBN. Moving on to the non-bank finance institutions, we have insurance, we have asset managers, we have alternate investment vehicles, we have niche finance companies, and then we have pension funds. I'd like to highlight here around the insurance companies. So insurance in Nigeria currently has a penetration that is less than 1%. So just to put it in terms, to put a bit of context to it, if you compare what we have in Nigeria to what we have in Thailand, India, Vietnam, and its other emerging markets, our penetration is actually very low. And so you find insurance in Nigeria still has a long way to go, and it has a large room to actually grow and support the growth of the insurance sector. So if you look at the demographics that we have in Nigeria, there's massive opportunity for growth in this sector. Talking about the asset managers are basically focused on ensuring that they provide and help their clients increase value, however, mitigating risk in every step of the way. And we have the niche finance institutions. That group of clients is focused on perhaps infrastructure, agriculture, and what have you. So they have specific focus in whatever it is that they're doing. Some of the key sector themes that we've had in light of COVID, I'll talk briefly on some of them. So we had regulatory oversight. So our regulators have continued to monitor, and that is just to ensure that we have a resilient financial institution world, such that we're able to withstand whatever it is that comes, be it in the form of low oil price or in the form of pandemic such as we have today. Another thing to also highlight that we're seeing is the oil price volatility and how that is affecting the macroeconomy of the nation. And of course, that also has a huge impact on the banks, given their exposure to oil and gas, providing facilities to ensure that this sector continues to grow and develop. A key thing that we're also seeing is also the recapitalization across the spectrum. So we have recapitalization of microfinance banks, we have recapitalization of the insurance sector, and we've also had of recent rumors on banking sector consolidation. So those are some of the things that we're seeing. Another thing that I would also like to highlight is the increased usage of online platform. So one thing that is evident amongst our clients, be it asset managers, insurance companies, is everyone has continued to ensure that they have an online platform that is up to par and to ensure that they continue to deliver service to their client in every way. So those are some of the themes that we're seeing in our sector within the financial institution world. Moving on quickly to something I'd mentioned earlier around, the oil price and depreciation. But one thing we would like to highlight here is, whatever it is that is happening, Stanbic IBTC remains an institution and an organization that is able to help you in terms of whatever it is you're trying to do. Are you looking at hedging your positions that you have in foreign currency? Are you looking at ensuring that you continue to generate returns? We have our asset management arm, we have our stockbroking arm that can continue to help you in this regard. Moving on quickly to some of the key business risks that we have seen. So we have put the key risk into 4 different buckets: credit risk, cyber and fraud risk, liquidity risk, and regulatory risk. So in terms of credit risk, one thing I'd like to highlight here is the fact that about a few weeks ago, we got a downgrade of the sovereign Nigeria. And of course, that has resultant effect in the cost of funds to financial institutions and how insurance companies in the country is being perceived. And so, that is a major credit risk that without any particular act by any of these institutions that we cover, there has already been a change to how they're perceived, and that is because of the downgrade of the sovereign. Another thing that I would like to highlight here is the oil price crash. So this is something that came about because of something that's happening in the global market, in the international market, but that has a resultant effect to our position here because of the exposure that the Nigerian banks have to oil and gas and the resultant effect of foreign currency earnings and what you're able to get given the current oil price. There's also the increased operations of business, that exposure to attacks and cyber attacks, and how that is affecting the business, and how organizations are ensuring that they keep a resilient firewall to ensure that hackers and what have you do not have access to their system as much as possible. There's also regulatory risk, where we have monitoring to ensure that we have a resilient team across the various sectors as much as possible. In terms of what COVID-19 has, the impact of COVID-19 and the roadmap, we sort of try to put this into 3 main buckets: short-term effects, medium-term effects, and long-term effects. I guess the immediate short-term effect is the risk-off sentiment. What do I mean by risk-off sentiment? Risk-off sentiment basically means that everyone is sort of just, holding on in terms of taking a decision on what they want to do. And that is because the current situation is something that has never been envisaged before. And because of that, everyone is taking a very cautious approach in taking investment decisions. I won't belabor the FX liquidity that we have, but I guess there is heightened risk management across the spectrum, be it insurance in terms of underwriting of any risk. All of that is being looked into critically before decisions are being made. There's also the fact that, in banks, everyone will need to ensure that before assets are being approved, everyone looks at it critically to ensure that there are no challenges in sort of assets that are passed through their books. Medium-term effects. I guess it's the fact that the work from home, I believe it's something that has come to stay. An organization will ensure that going forward, within a 1 to 2 year bucket, everyone runs an agile operation system. And that will mean, come to a lot of things, cost containment, and ensuring that organizations are agile and able to provide services as much as possible. Another thing to also highlight here is sector consolidation. There's a possible sector consolidation within the insurance world as they move to meet the deadline set by NICOM in terms of meeting their capital requirement. In terms of the long-term effect, I guess the winning strategy here is actually collaboration, and that is where you find telecoms, technology, banks, insurance, asset managers, everyone coming together to build a platform wherein goods and services can be provided to clients as much as possible. And of course, once that is done, you find that there will definitely be a realignment and resource restructuring as much as possible. And what happens when there's resource restructuring is that people start to think of new things. You start to think of new businesses and new ideas because you need to obviously grow the business and grow the market. Moving on to some of the expected reactions that we expect to see. So some of the expected reactions that we expect to see is the fact that, for the banks, there's a possibility that some of them may begin to breach single obligor limits. And that is when you take into consideration the FX, the conversion of the FX, and the impact that will have on their single obligor limits. So you find a situation where people start to distribute assets across the banks much more, just so as to ensure that everyone stays within the regulatory threshold. Another impact that we see here is the fact that there's possibly lower interest income is expected as risk mitigation procedures begins to tighten across the market. I guess something to also look out for is electronic banking fees. We expect that this line of revenue will have a spike. When we try to do an analysis, that was not quite evident in Q1, and that is perhaps because we only had 1 month of COVID-19 when people had to work from home in Q1. But I guess we would have Q2 to actually be a real reflection of when people are working from home and when we'll expect to see a spike in the electronic banking revenues. Another thing to also highlight here for offshore banks is we expect capital flights, people flying to safety because of what is currently happening. And there's a resultant effect in what that has for our risk-adjusted return on foreign portfolio in the market. Because as foreign portfolio investors, foreign banks begin to get worried about their positions, they want to exit the Nigerian market. There's obviously a resultant effect. I guess one thing to highlight here is on trade finance. Nigeria is a nation that depends on imports to a certain level. And so ever since the impact of COVID and of course the fall in the oil price, we've seen international banks increase their prices, the price on their trade lines across the market. And what that has is there's a resultant effect in the terms of the cost of this trade. And so of course we expect trade revenue to be on the decline as we go into the following months. On an insurance sector perspective, we expect a reduced retail business, and that's because of the lockdown. So we expect that reduced premium collection from retail business, because I mean businesses have been locked down now for the past few weeks, and I mean especially in the financial cities of the nation, in Lagos, in Abuja, and so what you find is retail businesses will not be able to meet some of their premiums, and so you expect that will reduce the premium collected by the insurance companies. And I guess we've also seen a situation where insurance companies have actually come together to engage NICOM, requesting that NICOM push further the compliance date of capital from December 2020 further down. Now, we do not know how NICOM is going to react, but I mean, those engagements we understand are already happening. In terms of our asset managers, we see lower appetite for Naira-denominated investment, and that's because of the negative sentiment for equity at the moment. But remember, as I mentioned earlier, in every situation, there's always an opportunity. So equities are at an all-time low. This is still an opportunity for you to partner with us as Stanbic IBTC stockbrokers, where we can work with you on whatever it is you're looking to achieve, or whatever position it is you're looking to take on within the market. We expect to see foreign portfolio investors sell-offs on Eurobonds, but we also expect to see increased appetite within the asset managers as they look to take on positions here. And I guess for the broker dealers, one thing to also position here is volatility. Because of the volatility and the depressed valuations, we expect volatility, and it's when there's volatility that stockbrokers are actually able to take positions and make some good revenue. So we position ourselves as that organization that can work with you in this particular season that we found ourselves, which is something that has never been experienced before across the market. Whatever it is you're thinking about, Stanbic IBTC is that organization that can work with you. I think I'll just pause here to take some questions. Thank you.
Thanks, Yewande. That was very insightful and quite detailed. So you mentioned Agile a couple of times in terms of what companies have to do to get out of this pandemic doldrum. What area do you think FI should focus on then in order to kind of get them that push out of this area?
Thanks, Olu. I think the major fact to highlight here is the fact that organizations must continue to provide service to their clients, irrespective of what is happening in the country, in the world. And to ensure that, organizations must build a strong online mobile platform to ensure that they're able to give value to their clients. So I mean, what do I mean by this? I mean that asset managers, for example, individuals should be able to sit in the comfort of their homes and be able to make investment decisions on the mobile platform or online platform of the organizations. And I guess so the key thing for organizations is to build a strong online and mobile platform that will ensure that they're able to continuously serve their clients as much as possible. The channels on those online platforms must work at all times to ensure that organizations give value. And what do I mean? I think organizations here stand a lot to gain here. And that's because once you're able to work on ensuring that you have a strong IT software and hardware to accommodate the anticipated bandwidth of business that you expect, I guess there's a lot of things that you can do with the data that is going to come on those online platforms. And I guess in our world today, data is king. And so there's a lot of things that you can do from the data analytics of the businesses, of the transactions that pass through your online platforms. And I guess it's the value for organizations is when they're able to use the analytics from that data to proactively create bespoke solutions for their clients. So without their clients, asking, you can look at the behavior of each individual and proactively create a product, create a solution. And I think that is when you will have created value. And so, but to be able to get all that data, you must actually be ready and be foolproof to take advantage of the situation. I mean, remember, never ever let an opportunity go to waste. You must always make use of a crisis, irrespective of what happens.
Good. Thanks, Yewande. So you've said that we should focus. The customers will focus on digital, in order to being agile, to focus on digital to drive their business on. With your sector, the clients in that sector are quite lots of regulators there running their business, or not running, but they are highly regulated sector, right? What role can the regulators play to help kind of accelerate these businesses as they recover from the COVID situation?
Thanks, Olu. I think one thing to highlight here is that the regulators within the financial institution world are actually on the right track. I'll just talk briefly about some of the things that we have seen. So we've seen some of the small businesses exempted from company income tax, and that's by the FIRS. We've seen tax rate for medium-sized companies revised downwards to about 11%. And that's just to ensure that the effect of COVID-19 is sort of reduced to help ameliorate whatever impact that would have. And talking about the central bank, we've seen the CBN come up with fiscal stimulus, several stimuli actually. And I guess one thing to highlight here is they've come up with a recent stimuli for households and SMEs, which is a total of about $138 million. And that is about 50 billion naira. And this facility is really to households and SMEs just to ensure that they're able to manage the impact of COVID as much as possible. We've also seen that the CBN has come up to reduce the rate on all their intervention funds from 900 basis points to 500 basis points. I think this is actually massive in ensuring that businesses continue to be a going concern. I guess the 400 bips reduction will go a long way in ensuring that businesses are able to take on the impact of COVID as much as possible, and whatever shocks that may also be coming from the foreign exchange, from the fluctuation in the foreign exchange price. I think there's also key is the fact that there's also a 1-year moratorium that's also been granted. I think all of this acts by the regulators is significant and a real steer to show that they understand what's currently happening in the world and in Nigeria, and they've already taken a move to ameliorate that impact for the sector. I guess in terms of the deadlines on capital, I think in the last week of April, CBN actually, came out and reviewed the deadline of compliance for microfinance bank in terms of compliance with their capital requirements. That compliance has actually been moved further down the road to 2022 and 2021 for National Microfinance Bank. I think these initiatives it's actually laudable, and I believe that the regulators are on the right track, and I think we'll come out stronger as a sector.
Okay, thank you, Yewande. So we're witnessing low yields on fixed income securities now. What are the opportunities available for the non-bank financial institutions?
All right. Thanks, Olu.
Thank you.
So I think for non-bank financial institutions to continue to drive yield, one thing that we want to suggest is the fact that you can look at other classes. There are various asset classes that you can look at. So Nigeria, for one, is one that has been touted globally to have strong agricultural prowess. And in having strong agricultural prowess, I guess there's still a gap in terms of what we're able to do in terms of meeting the agricultural demand within the country and also to export. So I guess non-bank financial institutions can begin to look at putting together agriculture funds to begin to look at mitigating those gaps that have been identified. So there are various products, crops that can actually be looked into to ensure that you continue to drive yield. When you look at the demographics of this nation, if we're able to feed this nation alone and have funds that actually actively go into agriculture, collaborate with agriculture, set up agriculture funds, I guess we will have phenomenal growth and actually continue to generate returns for our underlying clients. Okay. I think another thing that non-bank financial institutions can look at is creating infrastructure funds. When we look at Nigeria, the infrastructure gap is still significant. So you can look at various infrastructure gaps that we have in the country today and actually set up funds to look at those infrastructure, create the infrastructure, bridge the gap, and ensure that you're generating returns for your underlying clients, and as well bridging a key sector a key gap that we'll have in Nigeria as a whole. So I guess it's just to look at other asset classes that we have.
Okay. Yewande, so you mentioned on one of your slides talks to credit risk. If we look at in the FI world, these folks, they also end up lending to corporates. And if they were lending, if you look at just the oil and gas, if the portfolio was to depreciate between 25 to 40%, and then you factor in the COVID effect, who do you see are potential winners or those that would have issues in the next couple of months that one should look out for?
Thanks, Olu. I think my response here is going to be that I'll take you back to 2016, 2015, when there was the oil price crash. And I think majority of the Nigerian financial institutions have actually learned from that period. And so what you find is you found loads of organizations, financial institutions, they've all ensured that their positions are hedged as much as possible. So I guess we'll all come out winners. I mean, some stronger than the others, but majority of positions in Nigeria are hedged. And I guess in the wake of 2016, to help ensure a resilient financial institution spectrum, the CBN had advised that foreign currency borrowing should only be granted to players that have foreign currency receivables. And so I guess we'll all be winners in the sense that those foreign currency receivables are still going to continue to come, however, in a reduced manner. And so what you find is organizations will perhaps need to do a bit of restructuring in terms of taking into consideration the realities in terms of what the market is and what the returns is coming from the oil price. So whatever it is, people are wiser. People have hedges in place that they've built to ensure a more resilient institution. And I think a key underlying factor here is organizations are only lending to entities that have foreign currency earnings. So that is a natural hedge. And of course, there's also an additional hedge that has been bought just to ensure that oil and gas positions are not left open.
And I hope we were part of the bank that actually helped carry out those hedge transactions. One more question for you. You've identified the credit risk. We've looked at regulator perspective in terms of helping. What can we do, or what should we be looking at doing in supporting our NBFI clients in the next couple of months?
All right. Thanks, Olu. I think, speaking to all the NBFI clients, those already with Stanbic IBTC and those not with Stanbic IBTC, I guess this is an opportunity for you to sort of come on board and come home. And that is because we intend to work well with our clients to ensure that they have access to information and to ensure that we help analyze whatever information that is given to them. And what do I mean by this? We have a team that we work with in global market, our global market team. And I guess what we're going to do here is ensure that we work with each of our clients. Whatever your situation, there's always a bespoke solution that we're able to put on the table for you. And we would ensure that by proactively engaging you, explaining whatever the market is and whatever is happening in terms of the market, in terms of daily market updates, giving you access to information to ensure that you understand what is happening as much as possible. And I guess critically, to help you make that right decision that will help you ensure that you're giving value to your underlying clients, generating returns in a risk-free environment. So I guess that's the value that will give to our non-bank financial institution clients in the wake of COVID, as COVID begins to dwindle down, and even right in the middle of COVID, opportunities exist, and we're able to work with you.
Yeah, thanks, Yewande. And yes, absolutely. We are absolutely available. That's our role. We bring ideas, thoughts, solutions to customers once we have a good understanding of their business. Thanks very much, Yewande. We're going to pivot to Bola now. Bola, are you there? Bola leads our Conglomerates and Industrial Sector. And hi, Bola. How are you doing?
Hi, Olu. How are you
Good.
doing?
Very well, thanks. So, Bola, you've been talking to a number of our clients, CEOs, CFOs over the last couple of weeks, yourself and your team. What have they been sharing with us in the last couple of weeks?
Thank you, Olu. But before I answer that question, let me quickly run through what we do in conglomerate and industrial business. We basically cover three broad sectors. That is core industrial, real estate, and lately mining. In core industrials, we have iron and steel, packaging, we have healthcare, and chemicals. We also manage transport, which is aviation and automobile sector. And real estate, our real estate portfolio covers largely commercial properties and retail malls across Lagos and Abuja. And we have a respectable asset in that space. And we also cover lately mining. Mining because we're a member of Standard Bank Group, and we leverage on the experience and expertise of Standard Bank to develop mining desk in Nigeria. We have a mining desk that is building, nice portfolio now, and we hope to continue to grow that. But for the purpose of this discussion, I will focus on our core industrial industries. And these players, they have a theme that is common, which I would like to quickly mention. And that is they are highly dependent on foreign inputs. And their raw materials are not largely locally sourced. Hence, they have huge dependence on foreign currency to bring in their goods. They also have concerned with supply chain challenges, and they also do business to business. They don't sell their products directly to final consumers. So when you describe a company as a conglomerate, a company that is so described is one that operates in more than 3 unrelated sectors. So that is broadly what we do in C&I, which is called Conglomerates and Industrials. If I quickly go to what we saw and our conversation with our clients during the lockdown, in packaging comprising of glass manufacturing, aluminum cans, cartons, and PETs, which is plastic. We observed that the glass manufacturers shared with us that green bottles were not produced. Of course, green bottles were for beer, and beer was not part of the essential goods during the lockdown. Hence, what they did during that season was to just keep the furnace warm, which is cheaper for them than getting the furnace down, only to spend a lot of energy to bring it up. So they went through what they call a streaming process, just to keep the furnace warm. However, the other amber and light other bottles were targeted at non-alcoholic beverages. So overall, because beer constitutes a large portion of their turnover, they had a remarkable drop in sales for beer bottles. Same goes for aluminum cans. Aluminum cans, to about 50% of cans, chase beer products or alcoholic products, so to speak. So they also suffered a lot of sales, especially those of them who are operating in Lagos and Ogun. And I think the two operators operate in Ogun, so they actually suffered sales drop during the lockdown. For cartons producers, because they source their raw materials locally, they recycle used cartons. As a result, they were able to produce their pulp without relying on foreign inputs, and they were good because they supply FMCG, fast-moving consumer goods producers, and oil and gas, which are termed essentials during the lockdown. So they were quite fine, and they didn't suffer any supply chain challenge. For plastic was in high demand because they also supply alcoholic beverages manufacturers. So it was a good season for the plastic and cartons packaging manufacturers. For chemicals, of course, the pandemic made a lot of us to improve our personal hygiene. So we saw a lot of demand for chemical used for production of toilet soap and detergents, hand wash, and is basically what we refer to as soap noodles. Soap noodles was in high demand. So same for resins that were used for flexible packaging and plastics. Chemicals like polyethylene, polypropylene were in high demand during the lockdown. And we foresee a situation where chemical will continue to be in high demand because, personal hygiene has grown and is high. It's at its peak now. And we don't expect it to drop significantly because people will continue to be, to be conscious of their environment and take personal care of their hygiene. So chemical industry will continue to grow even post-COVID. If you look at in the steel space, all the steel factories were shut down. Of course, steel was non-essential. So steel manufacturers, steel converters, they were all really on lockdown. But what we saw actually was a pre-order going on. Some of the off-takers were requesting for products, anticipating that there might be increase when the lockdown is over. And that is what is happening now. So they are delivering to those who had pre-ordered. So because also government constitutes a larger portion of offtake in steel manufacturing, they actually witnessed a significant drop in their sales. For healthcare, that is a sector that has been begging for attention. So during lockdown, it was the only sector that everybody wanted to know what is happening. And everybody rallied around the sector, both government and private individuals, corporates, rallied around the sector to, beef up all the lapses that we have experienced. Nigeria, in terms of medical tourism, Nigeria spends 1.3 billion, going across the world to look for medical services. So, during lockdown, everybody just realized that, hey, this is a sector we all need to focus on. Health is wealth. So we will continue to see significant investments in this sector, and government, because this is a sector that whether good time or bad time, people will always get sick anyway. It's not cyclical business. So we will witness going forward huge investments in this sector. That is our view, and it's already happening because you can see even government is trying to encourage the players in that sector with the intervention fund that has been put on the table, that our people the health players need to tap into. This is a facility of a 10-year tenure, 2-year moratorium. We just have to get this going for the health sector because this is a sector that requires patient capital and long-term funding. So that is for healthcare. In terms of government palliatives, government has been very generous to our industrials. The seaports were opened, so a lot of them were able to move their goods out of the port during the lockdown. And like I said, government has also extended the moratorium for some of the federal government's funded loans, the ones that are issued by Bank of Industry, by Bank of Agri, Nexim, Nigerian Export-Import Bank. All those funds are now to enjoy extended moratorium, just to give the industrial players some breathing space, during this COVID period, because it's not going to go away in the next 1 year. So government is giving these strong palliatives, and people really need to tap into it. Again, Central Bank of Nigeria has also announced policy measure worth 3.5 trillion. That includes the 100 billion credit support for the healthcare sector that I just explained, and also have increased the moratorium from 1 year to 2 years, which is very good. And interest rates has also dropped from 9% to 5%. So these are things that will encourage our players not to really go down the drain. And government has also granted regulatory forbearance to banks to accommodate restructuring of some of these facilities. So these are the things that we saw during the lockdown. I will stop here for questions.
Thanks, Bola. And thanks for the insight. So what should companies be doing now post-COVID in terms of anticipation of the next couple of months?
Okay, thank you, Olu. To answer that question, I would like us to look at those who are winners during the lockdown and what made them to win. And what made them to win really is the fact that the players that were not highly dependent on foreign inputs were winners. When I mentioned the players in the packaging that are converting used cartons to produce their own paper pulp and then turn it back to cartons and recycling. Recycling has really helped that segment of packaging. So what they should be doing, what a lot of industrials should be doing now, is to first of all consider a strategic investment in backward integration. Backward integration of their raw materials is very key, because especially now that, the devaluation of Naira is going to impact a lot of them because they are import dependent, like I mentioned. If Nigeria imported goods worth 47.4 billion and 50% of that is importation for industrials, raw materials, and machinery, then it is very, very important for us to start looking inwards for our local inputs. The second thing that they also need to do is, when we talk about the supply chain is very important. Some of them will need to actually collaborate with logistic companies that will improve their supply chain going forward. So backward integration, looking for collaborating with logistic companies, or even setting up their own to diversify their revenue. Because some of the industrials who actually have logistic companies were able to service third parties. Even when those trucks were meant for their own use, they were able to generate revenue by servicing other companies. So they need to diversify their revenue by having related businesses that can help them show up their revenue during this time. So backward integration, diversification of revenue, and solid logistics and supply chain system is very important for them to win.
So maybe we should look at a few other questions. What do you see in terms of the this is just probably your opinion in terms of the fallout with regards to smaller companies that provide services for these conglomerates? How do you see a trickle down effect in terms of, because you mentioned backward integration, but do you see a trickle down effect in terms of how they might the relationships might change, or whether for good or for otherwise?
Yeah, because some of these investments, they may not have to make it directly, so they can outsource to smaller companies to carry out that for them, and then they would then be the major off-taker. I give you an example. If you want to set, if you are, let me look at the packaging industry, which everybody is familiar with. So rather than you going backward to to build your own paper pulp company and on the side. You can actually outsource that segment of paper pulping with a small player who will be doing the conversion for you. You don't have to do the conversion yourself. So you can give that player that opportunity to supply you and then be the off-taker. Because some of these things, it's really a big burden for them going backward. You could say burden because it takes them off their core business. If my core business is production of beer, for instance, why do I have to go into agric to start supporting farmers and all that? So why don't you just set up an SME or support an SME that will be supplying you the inputs that you need for your own factory, instead of you going all the way and almost become a farmer when really you are a beer producer. So yes, SME is very key for them. They will help them to source this thing and then feed into their own plants. So we need that coordination and collaboration with SMEs for the large corporates so that they can stay focused on their business.
I think this question for Yewande. I don't know, Yewande, are you there?
Yes, I am.
Okay. I think it's more around what do you imagine post-COVID? I mean, for companies. I think you touched on it a bit earlier, but especially your sector. What do you imagine would or companies should do? You talked about technology earlier on. Can you expatiate on that a bit in terms of interaction with, again, maybe smaller companies or smaller organizations that provide support for those companies as well there? It's not news that the Nigerian technology scene has took off a few years ago, and I think it's still on the upward trajectory in that sense. So what kind of opportunities do you see for the small players or smaller players or up-and-coming fintech firms or technology firms trying to
all right.
do something like that?
Thanks for that question. So I know I touched on the point earlier where I mentioned the fact that technology platforms, online platforms are key to ensure that those platforms work well. I guess for technology firms, I guess it's in working with institutions to provide the bespoke solution. So what you find is organizations may just, the small technology firms may just have a particular product that they just want to sell to the public. I guess my advice would pretty much be to technology companies to understand the asset manager's business, to understand the insurance business, to understand what the niche companies are doing, to understand what the banks are doing, and then create a bespoke solution. Because obviously those platforms are key. And I had mentioned that there has to be collaboration, technology, telecoms, and what have you. So for small upcoming technology firms, my advice would be to understand the sector in which you want to play, understand your product, and then create a solution. There are always things that needs to be solved because the current challenge that we're facing now is not something that Nigeria has ever experienced before, where we have a low oil price and then pandemic situation where people have to maintain social distancing. So I guess it's important that technology firms need to keep themselves abreast of the client's business to ensure that they're able to support those platforms. And I guess for the players within the financial institution world, it's no gainsaying that capital is key. And given what is currently happening in terms of the price of oil in the international market and what that will have, the revaluation that will have for some of the bank's books, and the impact that may have on some of the insurance companies that has that have written insurance or written insurance on the back of some of these assets. I guess one thing that will be key is ensuring that they have adequate capital to position themselves for proper business. If you look at what happened in 2016, I mean, after the crisis, there was a sort of boom, right, in the market. The market actually began to experience a boom in terms of new lines of business, but it's only those players that are positioned to take those opportunities that will have that will take advantage of whatever comes afterwards. And I guess it's just ensuring up capital as much as possible. I mean, we see NICOM that has come up with a policy on ensuring that insurance companies increase their shareholding. We've seen CBN come up with a microfinance bank to increase capital on microfinance banks. So we're going to see for me, I guess it's to ensure that organizations position themselves properly to have adequate capital to take advantage of those opportunities when they come. So this is the time to actually begin to plan, to position yourselves appropriately to take advantage from the financial institutions. While to your particular question, the technology firms need to understand the business of each of the subsectors. I mean, the whole subsector, if I look at it, is a total of about 9 of them. 9 subsectors. So you need to understand each of the subsectors and create bespoke solutions. I think that would be what will be helpful post-COVID. Thank you.
Thanks a lot, Yewande, for that. Very rich. I didn't realize one question like that could be expanded into a lot. I mean, it's a lot. I was taking notes myself. Maybe I should venture into one of these subsectors for some opportunities in there. Let me quickly ask Bola here. So can you talk through a few things around what Stanbic is doing to help industrials?
Okay, thank you, Taiwo. You see, it's unusual time we are in now. And Stanbic IBTC, being an investment bank, will be in a very good position to help our industrials. Our investment banking team will throw a number of products at them for them to grab and start. It's a time for industrials to beef up their capital base because of depreciation. There will be need for financial advisory, balance sheet restructuring at this time. Like I said, it's an unusual time and it requires unusual solution, and it is investment banking solution. So Stanbic Capital has a portfolio of products that will support industrials this season. So financial advisory, same goes for our equity capital markets. A number of them will need to raise capital at this time. Patient capital is required, and to do that, we are the number 1 in that space. So we will need to support them by looking at their balance sheet, looking at the need for them. If they need to raise capital from the floor of Nigerian Stock Exchange, we will do that for them. Same goes for debt capital, long debt capital, bonds and commercial paper. Bonds especially, we have the expertise for bond raising in Nigeria. That is known by all and sundry. So we are the one that will support them to raise 10-year bond from this market at good rates, so they can show up. For working capital, a number of these industrials will need to augment their working capital, and that is available in our TPS, transactional product and services. Because of liquidity squeeze for a number of our clients, they will not be able to support a number of their staff with staff loan and all that. So we have the personal loan that will be able to support their staff, not just supporting the corporates. So that's why we are a universal bank. We will not just support the corporates, we will also support their contractors, support their staff, just to ease the cash constraints that they are going to have during this season. And this season, when I mean season, is not 3 months, it's not 6 months. The next 1 year, a number of them will need to, engage a bank like Stanbic IBTC to help them restructure their balance sheet and help them float. Otherwise, I mean, a number of them will have to buckle up this season. That is those are the things that I think industrials will need at this time, and it's largely investment banking products, which, of course, we are number one in the markets. Thank you.
Thank you, Bola. Thank you, Yewande. Olu, thank you. Unfortunately, I think he's dropped off. We will leave it at that for now. I think our audience, they've heard all the opportunities that are available. They've gotten all the insights and the various ways in which Stanbic IBTC can partner with them, or that they can partner with Stanbic IBTC through some of your solutions, services, and other offerings. Thank you, audience, for watching. This has been an edition of Blue Talks for today. Until next time, stay safe and bye-bye.
Thank you.
Thank you. Bye.
Thank you. Bye.